Good morning, everyone. My name is Frank Balistreri, and I lead Sensiba San Filippo's consulting practice. Thanks for joining our webinar on lease accounting today. This is the second in a series of webinars that we have planned over the next several months related to lease accounting. You will see that the chat function is disabled, but the Q&A function is enabled. So please put your questions and comments in there. We're going to do our best to respond during the webinar and consider what you put in there for additional topics for future webinars. If we don't get to your question today, we're going to follow up with you after the webinar. Towards the end of our presentation, we're going to ask you for topics relative to lease accounting that you'd like to see discussed on future webcasts as well. I wanted to make you aware that now, so that you can give some thought to it during the presentation today. This is being recorded, and the slides and the link to the recording will be sent out later today by our team. And as we've done over the last few webinars, we are offering CPE for this presentation today. You have to view it live, and that means there's going to be some polling questions. So about every 15 minutes or so, we'll pause for a polling question when we get to a good spot in the slides. Please make sure that you respond to all of those if you're in need of CPE, and those certificates will come out automatically after the presentation today. And if you don't get them within about a week, just please send an email back into us so we can make sure that you get them. I'm joined today by my partner, Kevin Shives, and also by Joe Burnell, who's a senior manager in our audit department. We're kind of the core of the lease accounting implementation team here at SSF. And then we've also got Jess Vento, who is from our software partner, LeaseCrunch, and she's going to do a demo of the software a little bit later in the presentation. Just a little bit about us in case you don't know. So we're a full service accounting, consulting, and advisory firm. We have 4 offices in Northern California and 2 offices now in Oregon. Pretty excited about that. We serve clients now across the entire US and have been in business for over 40 years at this point. In addition to audit and tax, our consulting group, which I lead, offers a wide range of services, including fractional CFOs and controllers, outsourced accounting, internal audit, and a whole host of technology solutions, which will flash on the screen here in just a second. And we're also one of a handful of accounting firms that's B Corp certified, a designation that indicates that we strive to balance purpose and profits. You can find more about that online at our website at www.ssfllp.com. And there's been a lot of interest in B Corp certification, especially amongst companies that focus on sustainability. We've got a number of folks internally that can help with this. So if that's something that you're interested in, please check out our website and get in touch with us.
Yeah, thanks, Frank. Specific to SSF Consulting, as Frank mentioned, we do provide outsourced accounting, internal audit SOC solutions, and we also have a technology practice where we work with the software vendors that you see on the bottom right-hand corner of the slide. Of course, accounting for leases being the focus today, we will be providing a brief demo of LeaseCrunch toward the end of today's webinar.
Here's our agenda. We're going to cover ASC 842 from the lessee perspective on this call. We've done a little bit of looking into the lessor side, and it's really not all that difficult. So the webinars that we're going to do are really going to be focused on lessee accounting from here throughout the rest of the series that we're going to do. Some of what we're going to discuss today was discussed on our last webinar, and also in the series of webinars that we hosted last year. This is really kind of a lather, rinse, repeat type of thing, although we are updating the slides for what we're learning as we go through more and more implementations. And the feedback that we received last year and through the ones we've done this year is really that you need to hear this kind of over and over again, very similar to a lot of other things that we learn that are new. The reminder and the explanation of what we're doing becomes really important. With that in mind, we're going to cover some key definitions again today and some background information on the standard, some of the adoption requirements. We'll take a look at some practical transition guidance that we think will be helpful. We're also going to talk about the practical expedients that are available for adoption purposes, and then, excuse me, present some different options regarding discount rates. And obviously, as we move into an environment where interest rates are moving, that's going to raise some additional questions. So we have been getting a lot of questions on that. The good news is that's really more of a current phenomenon, not necessarily a historic phenomenon, which is where we'll deal with many of the issues related to the adoption of the new leasing standard. And then on the tail end of all this, we're going to demo the software that we've chosen to work with, which is LeaseCrunch, and that's why Jess is with us today. And I think once you see the software and how simple it is to navigate, and you see some of the requirements that you are going to have to adhere to relative to that in terms of getting information into your footnotes and such, it really becomes pretty obvious that getting a software solution is going to be quite helpful, because this isn't a do it once and put it on the shelf type of exercise. Unfortunately, there's some ongoing maintenance, and depending on the type of leases and the terms, you may have some additional items that you are going to need to cover and need to keep track of throughout the life of these leases. And once again, like I said, you're going to notice that we're covering some of these items multiple times. It's because they're important, and we know that to really learn it, you're going to need to hear it from us more than once.
Thanks, Frank. On the next couple slides, I'm going to go over some key definitions that you should be aware of. Under ASC 842, we have two types of leases: financing and operating. The criteria for a financing lease are spelled out on this slide. These are slightly different from the bright line tests in the old standard under ASC 840, which were the lease term was greater than or equal to 75% of the useful life of the asset, and the present value of the minimum lease payments were greater than or equal to 90% of the fair value of the leased property. One key point I want to note here is that the commencement date is the date that the underlying asset is actually available for use, and may be different than that actual lease term. Think of a construction period allowance as an example. Okay, next here we have the lease term. This is an important concept as it does take some analysis to figure this out. The reasonably certain threshold is used here. Think of a supermarket that signs a 5-year lease with 4 additional 5-year extension options. Then they proceed to incur substantial leasehold improvements to open the store. It's unlikely that they will be out in 5 or maybe even 10 years. Their lease term may be 15 years or longer. There are many factors to consider, including past practices. For discount rates, the FASB also made the interest rate decision a bit easier for private companies by introducing the risk-free rate as a viable option if elected. And we will delve deeper into the concept of discount rates later in this webinar as well.
Yeah, Joe, I know from some of the consultations I've done, I get some companies asking, hey, can we schedule our lease agreements now so that we schedule it for a 1 year with a bunch of options on the back end so we can avoid doing this? Unfortunately, the answer to that is no. You really do need to, like we said in this example, take a look at what your ultimate plans are. So the FASB thought about some of these circumventions, and that's certainly something that they put in there to avoid that.
Yep, that's a great point. Thanks, Frank. Okay, we have a couple more terms you're going to see used throughout the new standard. Right of use asset, or ROU, that's one of the new ones. This is the balance sheet asset that's going to be booked as of 1/1/2022 or upon your adoption of the new standard. And we're also going to have that corresponding lease liability associated with that right of use asset. Another term is initial direct costs. These are going to be tracked and factored into that calculated ROU asset rather than tracked separately under the old standard. Another big thing here is lease modifications, because these may trigger a remeasurement of your leases in the future. Think of what we've gone through over the past 2 years. In some cases, there were significant lease modifications that require remeasurement of the lease liability and perhaps even an impairment to that right of use asset.
In terms of effective dates, the standard was originally effective for public companies all the way back in January of 2019, and it was delayed for private companies, municipalities, and not-for-profits. For these entities, it's now effective starting January 1 of 2022 for a calendar year in company, so it's already effective. But for many municipalities and not-for-profits with June year ends, it will be effective starting a little bit later on this week, July 1st. And the overall goal of all of this is to get these operating lease liabilities onto the balance sheet. Okay, so now that we've covered some of the terminology, here's a high-level overview of the requirements. So what you can expect is more disclosure in the financial statements related to this, new policies, and a discussion of the major assumptions and the practical expedients that you're going to employ. Kevin, there are several practical expedients that are out there, but I think there's one that we see used more often than not. Can you talk about that real quick?
Oh, you bet. Perhaps one of the most basic of these expedients is whether or not to include other lease costs in the lease payment. So take, for example, triple net lease, which is very popular amongst our clients. The question would be, do you include the CAM charges in the base rent amount? How about taxes and insurance? Well, you would, but only if they're fixed. And this is a policy election, of course, that will need to be disclosed. If the other lease costs are not fixed, then they are considered variable payments under the standard, and they don't go into the calculation of the lease liability or the right of use asset. However, as we've pointed out multiple times, there's a lot more disclosure, so you would have to disclose those variable payments even if they weren't included in the calc. As you'll see in the demo coming up, LeaseCrunch provides a way to track these variable payments and then allows you to print out the disclosure footnote ready for the financials. Very convenient. We will explore other practical expedient options a little later in the webinar.
Thanks, Kevin. And companies are also going to have to choose how to adopt the new standard. I've seen reports that show that this is really a mixed bag on whether or not companies will use what's referred to as the modified retrospective approach or the comparative approach. And we'll have more on that later in the presentation. And some of that really depends on what are your future plans, right? If you're a company that has aspirations of going public, you may want to look at this a little bit different than a company that intends to stay private. So when all is said and done and the dust settles here, it's expected that there's going to be about $3 trillion worth of lease liabilities with a corresponding right of use asset that's going to get recorded as the result of adopting this new standard. Lessees are going to be the ones that are most impacted by all of this. And there's two concepts that are really of importance here, and they're highlighted on this slide. So contracts that a company enters into will need to be examined to determine if they are a lease or contain an embedded lease. A physical asset has to be identified in the contract, and lessees will have to have the right to control the use of that underlying asset. And control is defined as being able to take substantially all of the economic benefits of the asset through the lease term, and also directing the use of such asset. If both of those are not met, then you don't have control and the contract is not considered a lease. Also, lessors can't substitute an asset. So what I think about there is somewhat the concept of like a contract manufacturing situation, right? Are you taking all of the production out of a particular plant, or do you have a fleet leasing agreement where the lessor can substitute trucks or whatever it is? Those decisions there may change some of what we're talking about here. So we thought it would be helpful to discuss how to actually implement this and share with you some transition guidance. First and foremost, you need to be familiar with the standard, and there's a million ways that you can do that. You can read the entire document, or you can search the web for a summary of the standard. There's a lot of detail out there now, especially since we're so far beyond the initial implementation. And as Kevin previously mentioned, depending on the size of your company, you may also need to figure out who needs to be on the implementation team, and that's really dependent on the size and complexity of your business. So some things to consider there, do you have a legal department, a purchasing department, a finance department, and do you have people in operations? These folks may all be touching, agreements and contracts that are out there that may be considered leases. The other thing that I think becomes important, are you a fairly centralized or a decentralized organization? If you're centralized, this is probably going to be a little bit easier. And if you're decentralized, you may have, some additional reach out that you need to do. And so once you have the team in place, then you can start to work on actually coming up with the necessary information for the implementation team to review. And we're going to move over to that in just a second. But first, we're going to pop up our first polling question. Okay, so the first question is, how would you rate your preparedness for adopting ASC 842? And we've got several items there. And we're about 50 responders. We'll give it just a couple of more seconds here, because I know people that need CPE are going to want to make sure they get in on this. So what I'm seeing on my screen, which I'll share in just a second, we're at about 63, 64. A few of you are well prepared. A good group are somewhat prepared. There's a big group, about half of you, that are still gathering facts. About 10% are not prepared at all, and about 13% are unknown. So let me end that and share the results with you real quick. You can see that on screen. Okay, there's the results of polling question number 1. And so Joe, maybe you take it over now and tell us where to start this whole process.
Yep, can do, Frank. To start, we need to determine our population. The actual leases are fairly easy to identify. It's the other contracts that could be a challenge. So I would start by reviewing general ledger accounts, maybe looking for recurring payments, or even run some vendor reports that would have a good list of recurring payments as well. Another reason to cast a wider net beyond known and identified leases, especially in some larger companies, is because you're going to have a lot of people throughout the organization that are touching these leases, entering into contracts, and ultimately that implementation team is going to have to get comfortable that they have a complete population to start with. Document retention is also something to be considering. And one thing that we want to also consider is who's maintaining what where. Are there multiple people who have custody over all this information? So it's really important to get your team together and make sure we have all complete sets of data in one place. Another thing is just reviewing your general ledger also allows you to look at some of your 1231 balances that will actually not exist going forward under the new standard. These include things such as deferred rent, prepaid rent, rent deposits. All these accounts are going to be netted against that right of use asset upon your implementation. So it's imperative that these accounts are reconciled fully and completely as of 12/31/21 to allow for a smooth transition under the adoption process.
Next up, you need to create a list of what you find. Kevin, can you walk us through what you like to see in what I refer to as the inventory of contracts?
You bet. So the goal here is to reduce the number of touches with each of these documents. A best practice is to create what is commonly referred to as a lease abstract. And this is a summary of the key terms of the lease or the contract. So you start with understanding the requirements of 842, and then you need to have easy access to the components that you're going to need to run the various calculations. Doing this will save a ton of time down the road. You know, when we get into the LeaseCrunch demo, Jess will show us how you can store all of this documentation within the software itself.
Under 842, payment types are important, and we touched on this a little bit before, but we're going to hit it again here as they're treated differently. Joe, can you please cover the payment types and how they are treated?
Yep, can do, Frank. 2 payment types we have summarized here on the screen. You have fixed payments and variable payments. The fixed payments are the same each month, and they're going to factor into that calculation of the lease liability and the right of use asset. For example, it sounds pretty simple, but just think of your minimum monthly rent as known and a predictable amount that you pay every single month. Now, variable payments, on the other hand, these are going to be different every month. Think of your CAM charges, or maybe you have a percentage of rent based on revenues. As these are going to vary month to month, they're not factored into the initial calculation of the lease liability or the right of use asset. Instead, they're going to be treated as a period expense, but they do still need to be tracked for disclosure purposes. So if you have a lot of these variable payments, this can become an administrative burden to deal with. And what you're going to see later on is that LeaseCrunch is a great tool to kind of collect, track, and keep all of these payments in one place so they're easy to disclose at the end of the year.
Here's what I like to refer to as the items that are supposed to make my life easier. So we've mentioned some of these already. So for example, combining lease and non-lease payments will simplify the recording of the amounts. And for private companies, you're also allowed to use the risk-free rate so that you don't have to go out and try to figure out one of the other rates that's available, like the incremental borrowing rate, or calculate the implicit rate that's not clearly stated in every lease. There's also a practical expedient that allows you to exclude leases that are less than a year in length in the ROU and lease liability calculations. But remember, you must track these for disclosure purposes under the new standard. And as I mentioned before, you can't try to cherry pick this situation and set up all your leases as being less than a year and have them carry on for multiple periods beyond that. And then finally, there are policy elections to apply discount rates to classes of assets. So think of that rental fleet, like I mentioned a little while ago, that a company may have. It's important to have someone on the team that knows the nuances of each of these policy elections and practical expedients, as it's going to save you a lot of time in the long run as you go through the implementation. Here's a few more. Some of these will help during implementation. So you don't have to go back with hindsight and reassess the lease classification or initial direct costs for leases that were entered into before the standard was adopted. And then on the flip side, there may be some instances where you do want to apply hindsight for certain items, such as the lease term, purchase options, or termination options. And we will discuss practical expedients in a little more detail later on in the webinar. Proper classification between finance and operating leases is also critical. In actuality, it impacts the timing of expense in the income statement, and it also impacts geography in terms of where it gets recorded. So with a financing lease, you're going to have two components to expense. You'll have lease expense and interest expense. Under an operating lease, you just have lease expense. For a financing lease, you use the effective interest method, and for an operating lease, you use straight line. As you can see above, a financing lease is very similar to what we used to call a capital lease. The main difference is the removal of the bright line tests mentioned previously by Joe in the webinar. The removal of the bright line test does increase the need for judgment in documenting any judgment with regard to financing lease determination for a certain asset or asset class becomes an important factor in the transition process from 840 to 842. And then we also mentioned this previously too, but you should also note the introduction of the concept of reasonably sure. So you have to have one of the items under a financing lease for it to be a financing lease. Otherwise, it's just an operating lease. Lastly, once you go through your entire process, you have to determine how to actually adopt the standard. Joe, you've done a bunch of these now. What are the two ways of adopting, and do you have a favorite?
I do, Frank. So the FASB did us a small favor here by letting us use what they call the effective date method. Really what that means is if you're a calendar year-end company and you're going to present comparative 2021 and 2022 statements together, this means that 2021 is shown under the old standard. You don't have to change anything for that year. You only have to update for the 2022 presentation. So the effective date method is my preference, as it doesn't require doubling up the work to go back a year upon that initial adoption. But Frank kind of alluded to this earlier. If you're a new public company or you have aspirations of becoming a public company in the future, it's going to be a wise choice to actually go with that comparative method and do the full retrospective adoption. So that's definitely something to consider.
Thanks. Okay, this next segment is going to focus on drilling a little deeper into two important topics to consider prior to adoption of the new standard: the practical expedients and the discount rates. Joe, can you tell the audience more about some of the practical expedients available to them?
Can do. First off, a company needs to identify its fixed consideration and allocate that across both lease and non-lease components. This requires performing an analysis to determine method of allocation for every contract or lease you have. The problem is, this can be very difficult to determine the value of lease and non-lease components of each contract separately. In addition, the fixed consideration doesn't always include all the variable costs such as CAM, insurance, taxes that most real estate leases have, as I mentioned before. So in response to this practical expedient spares you the time from having to perform all of that analysis to determine the allocation methods. Instead, you can simply calculate the present value of the fixed payments without having to perform an allocation to the lease and non-lease components. And the result, which I think we all appreciate, is time saved. Kevin, what options do lessees have with regard to historical hindsight when adopting the new standard?
Sure, Joe. The hindsight practical expedient says that when you're determining a lease classification, a company can consider the actual outcome of lease renewals, termination, and purchase options that were previously evaluated. The hindsight expedient must be applied to all leases during the comparative period. And something to consider for a company with a large lease portfolio, this could be pretty labor intensive. So keep that in mind before considering to adopt this expedient.
Thanks, Kevin. So this next package we have here is a package of 3 that you would adopt all together. So this isn't pick one and ignore the other 2, but it is going to reduce the time and effort you'll need to spend going back to reevaluate lease accounting decisions made under the old standard. It also helps reduce the time and cost of preparing financial statements to meet the new standard under the transition requirements. Most companies that have already adopted the standard have utilized this batch of practical expedients. However, there are always exceptions to the rule, and you might not want to elect this package if you will benefit from the lease reassessment. An example, just to kind of show you quickly, if most of your operating leases would have qualified as a financing lease under ASC 842, and in the end, that reclassification might have a serious impact on your EBITDA for some of your previously reported financial statements. So you might decide not to elect this package if that's appropriate for your company.
Okay, so we've already covered the effective date method. So I'm going to jump down to the short-term lease expedient. So electing this practical expedient will save you time in capitalizing fewer leases. However, while short-term leases may not be going on your balance sheet, of course, you guessed it, it has to be disclosed in the footnotes. So a key point here is if a company historically has renewed a 12-month lease year after year, this cannot be excluded from the capitalization requirements. So you have to look at past practices before you elect not to capitalize a lease that is 12 months or less. So the next element on here is private company discount rate alternative. So if you don't already know your incremental borrowing rate, your IBR, then applying this expedient offers an alternative to performing any complex calculations to determine it. The downside is that the risk-free interest rate is typically lower, which would result in a higher liability on your books. So that's something to keep in mind.
Thanks, Kevin. Let's see, we're going to touch on discount rates again here. So now we're going to move on to exploring the discount rate options. And before we do that, can we pop up our next polling question? Okay, the question here is, what would be more beneficial to you? A smaller liability on the balance sheet, a larger liability, or not sure at this time? We're about 45. So the smaller liability seems to be at about 40%. Larger liability, nobody has checked on that. And then a big portion of you are still kind of unsure at this point. I'll let it go for another couple of seconds here so we can make sure everybody gets CPE that needs it. we're at about 64, 65, which is about where we were before. So I'm going to go ahead and end that right now, and I will share those results with you. So it's a 60-40 split right on the nose. About 40% said smaller, and about 60% said not sure. Okay, Joe, let's talk about the 3 discount rate options that lessees have, and which ones we think are going to be most applicable.
Okay, first discount rate option is known as the implicit rate, or IR. You can see the definition on the slide here. Now, in order to determine the implicit rate, the lessee needs to know the assumptions used by the lessor in pricing the lease, including the underlying asset's fair market value, the estimated residual value of the underlying asset at the end of the lease term, and any initial direct costs deferred by the lessor. So what's the result? As you can guess, most lessees are going to prefer not to use this rate and choose either the incremental borrowing rate or the risk-free rate, because to get the information for the implicit rate, that's usually not readily available to the lessees on their end. Second option, as I just mentioned, is what is known as the incremental borrowing rate, or the IBR. I've listed some common myths regarding how to determine or calculate your IBR on this slide. For example, the IBR for a piece of commercial real estate would be vastly different from what it might be for a copier lease. Now note, if a lessee elects to use the incremental borrowing rate, one rate can be applied across a similar group of assets, a vehicle fleet, for example. So you wouldn't have to calculate that for each vehicle. Maybe you have a fleet of 40 vehicles out there. You can calculate one rate for that entire fleet. In industry terms, we call this the portfolio approach, which we've mentioned as one of the practical expedient options previously. Now, one thing I want to point out here to be careful about is if you're going to use the IBR, it's going to be tailored to each asset or asset group under the lease. And of course, the standard does not prescribe a method or a calculation framework for how to come up with the IBR. And there are a variety of methodologies that a lessee could use, making sure they have to consider things like the maturity of the lease, the term of the lease, any collateral associated with the lease, the economic environment, and entity-specific credit risk factors of the lessee. So again, I think you're going to notice here that these first 2 rate options involve a lot of judgment, a lot of gathering of information, and just a lot of extra time on the adoption process. So before I get into the third rate, which is the risk-free rate, I want to give you a couple more examples on how, if you do elect to use the IBR, on what you can use to calculate that amount. So, for example, rate on existing debt is 1. A lessee might have an existing debt facility or even a loan that it can be referenced when estimating the IBR, but it wouldn't be appropriate to use the same rate for all of your leases. The lessee would need to assess whether any events, changes, and circumstances have occurred between the execution of a debt facility and the execution of a lease. What does that really mean? If you have a line of credit for $1 million and you have an asset you're planning to lease that has a lease life and total payments of $200,000, you can't just take that rate for the $1 million line of credit and apply it to your lease that has a total value of approximately $200,000. So you have to factor in all these various terms and specifics to come up with your true IBR. Another thing here is borrowing rate of similar entities. One option is to maybe research public debt markets to determine the borrowing rates for entities with credit risk similar to the lessee. But the lessee would need to adjust the reference borrowing rate so that it meets the definition of IBR. For example, if the borrowing rate is associated with unsecured debt, the lessee would need to adjust the yield to reflect full collateralization. Again, I'm guessing a lot of you don't want to go through this exercise of coming up with these calculations, assumptions, and judgments under the IBR. Now, the last one here, rate quoted by lender. This might be a little easier to come up with. So a lessee could ask their lender to provide a written quote rate that they could borrow against for an asset that has a similar life and similar term to what your lease might be. But again, all of these have rate-based assumptions that need to align with the standards under the IBR definition, and it really results in a lot of extra work that you have to use. So what do we have here? We're going to really recommend that the risk-free rate is used by companies, and we're going to get into that a little more here later. So I'll have Kevin take that away.
Bet, Joe. So, if you're using the risk risk-free rate. If a lessee is making this policy election, you got to remember this must be applied to all leases, and the election, of course, needs to be disclosed in the footnotes. In June of 2021, the FASB issued an ASU amendment that would allow lessees to make the risk-free rate election by class of underlying asset rather than an entity-wide level. That amendment also requires that when the rate implicit in a lease is readily determinable, then a lessee must use that rate regardless of whether they've made this election. So a little tricky there. Another practice point is, even though it's complicated, some companies are opting to calculate an IBR as opposed to using the risk-free rate. And the driver for this is, the IBR is going to be higher than the risk-free rate. And so that's going to result in a lower liability on the face of your balance sheet. So if that's important to you, then you definitely want to consider these options carefully. And we at SSF are ready to jump in and help you to make some of these decisions if they get a little tricky. And then the last item on here is the discount rate reassessment. So anytime you've got a modification to a lease, then you need to reassess that discount rate and recalculate the ROU and the associated liability using that revised discount rate. And it's at the modification date.
So guys, right now we're in a time where interest rates are starting to move finally, right? For years, they were historically low. And I think one of the questions that we get is based on a little bit of confusion, right? The rates are moving currently, but we're still kind of dealing with history here, right? So even though rates are moving in the current environment, when you're adopting this, it's a look back, right, Joe? So they're going to have to go back and look at what the rates were in effect back when this lease was entered into, correct?
Correct. So, and one key point I want to clarify for the group here is upon adoption, that's the rate that you're going to be choosing. So it's going to be your rate as of 1/1/2022, for example. So as you can imagine, the rates, were, 1/1/2022, as I said, the rates were a lot lower. But one thing to really consider is you might have had a rate that was in existence 3 years, 4 years ago when you started this lease, and there is an option to use that original rate rather than the rate as of the adoption date, if that is more beneficial to you. So there is just some nuance and some tinkering and some investigation that needs to be done. It's not just a pick a rate and don't think about it and go forward. So we're happy to help with some of these questions and decisions too.
Yeah, and we're in that environment where it's kind of an inverse relationship too, right? Where the lower the interest rate, the higher the liability, the higher the interest rate, the lower the liability, but then you've got this interest expense component that's going to flush through your P&L.
Okay, so lastly here, we don't want to forget about our disclosures. And the one key I want to emphasize here is not just disclosing the numbers, the data, the rates, things like that. We're also going to have to be disclosing some of the significant assumptions and judgments used in applying this new standard. And as you've heard throughout the webinar, there's a lot of decisions, choices, elections that need to be made, and those all need to be factored into the disclosures that ultimately make it on the financial statements. And then what we're going to do here next is just take a brief look at what it might look like with a couple different discount rates between a low rate and a high rate on what your disclosure might look like, present value might look like, etc. So what we have here is the difference between two rates. On the left column, you can see a lower rate of 2%, and on the right column, you can see a higher rate of 7%. And really what it's showing here is that you're going to have a larger ROU, and liability is going to be calculated for the same lease term when you're using that lower rate. So if you look at the slide here, kind of in the middle of that slide, your right of use asset is about $70,000 higher right there, and your corresponding lease liability is about approximately $65,000, $75,000 higher there as well. So probably not going to have a huge impact on your financial statements under this example, but there are some companies out there with gigantic lease portfolios, and we're talking millions, if not, 5, 6, even up to tens of millions of dollars that do end up as right of use asset and lease liabilities on their balance sheet. So that can really extrapolate into a big difference between those two rates.
Yeah, I think, one thing to keep in mind there too, Joe, is for a lot of our clients that have, between 1 and, call it 5 to 10 leases, the reality here, I mean, we've got a 5% spread on the interest rate here. We're not going to have that in actuality. So the difference is really going to be pretty minor. And this should be a relatively simple exercise, although it's the documentation behind it that really matters. Okay, so we've tried to simplify our approach and the services that we offer so we can serve the needs of all of our clients. And some, from what we've seen, are going to need a full outsource of this because they just don't have the bandwidth to deal with it. And some may just need some assistance with portions of it. So if we are more involved, clients are going to need to ensure that they take full ownership for the process. So here comes the independence requirements, right? Kevin, can you walk us through the boxes here and focus on what a total outsource may look like and how clients can take on portions of the project themselves?
Sure, Frank. We've set up our offering to provide clients options across the services shown on this slide. We suspect that many companies, especially year one, they're going to want more help here. So for them, we can outsource the whole effort. Others will have an implementation plan and the internal resources required to handle it. So maybe they just need a tool to help with the calculations, the footnotes, and to simplify the maintenance. We can provide that as well through the LeaseCrunch software. To help clients figure out where they are on all of this, it all starts with an assessment, where we'll go through and help clients figure out their preparedness for the standard and what level of service that they're really going to need. We have a nice checklist and guide that makes this assessment very effective and efficient.
So those with variable leases and potentially embedded leases may want a little more support from us, especially in the early part of this process. For our clients, we believe that the risks for embedded leases are going to fall into the following categories. And I know there's a question in the Q&A that somewhat touches on this as well. So IT service contracts, if there's an underlying dedicated server that's embedded in the contract, that needs to be evaluated. That's probably not as common for the lion's share of our clients, but those of you that are on the larger end of our client spectrum, you may have that. So for our manufacturers, I talked a little bit about this earlier. Do you take all of the output from a facility in a contract manufacturing scenario? Or is there a specialized piece of equipment? This comes into play with a lot of our food and beverage companies that may have to have a specialized piece of equipment that's used solely for them. That could result in an embedded lease. And then finally, in our construction practice, what we see are a lot of dedicated assets in service agreements that may need to be analyzed. And if the lessor doesn't have the option to replace those assets, then those may be considered an embedded lease as well. So next we are going to turn it over to Jess to do a demo on LeaseCrunch. We're a little bit ahead on timing wise, but I think we're going to put up one more polling question before we get in to Jess, and then we'll turn it over to her and I will stop sharing. So let's roll that next question, please. Okay, the question here is, which rate do you plan on using? We've got the ones we talked about: IBR, risk-free rate, implicit rate, or not sure. And we'll let that roll for just a couple of more seconds here. So it looks like, roughly half are in the risk-free rate and roughly half are not quite sure at this time, which is kind of what I would expect. We're into the 60s. Give it just another second or so here. I am going to go ahead and end that poll, and we'll share the results with you real quick. So, about 6% said IBR, about 40 said the risk-free rate, about 5% said the implicit rate, and a big portion of you are unsure. So that's kind of what we would expect, and certainly we're available to help with that. So I'm going to stop sharing there, And I will stop sharing altogether. And we're going to turn it over to Jess to spend a little bit of time talking about LeaseCrunch.
Thanks, Frank. Good morning, good afternoon. The things that the team is talking about here today are things that we hear about all the time here at LeaseCrunch. So hopefully seeing a quick demo of how to add a lease and then run a couple of reports will be helpful for you today. I'm already on our Add Leases screen, and we'll get back to our My Leases screen, which is kind of home base and where we run reports in just a minute. But what I want to do is just take a few minutes to run through exactly how to add a lease here in LeaseCrunch. What I'm going to do here today is enter a transition lease. So Joe and Frank and Kevin talked a lot about transition leases already today. And we know that many of you have transition leases. We've accounted for those under 840, and now we're going to transition those over to 842. There's really about 12 required fields in LeaseCrunch to get your lease entered. So really a quick way of going about it. The first thing I've done is I've selected my reporting entity and lease name, a bunch of optional fields called description, manufacturer, and then we talked about asset types. One of the things that the team talked about here today was based on classes of assets. So here in LeaseCrunch, we can set up those asset classes and track our leases that way. We can also track our leases based on locations and lessors. So if that's something that's helpful to you or your organization, that's something we can certainly set up within our system, and you can track the leases that way. The next thing I'm going to talk about that's really a time saver as it relates to determining renewal options, we talked a little bit about that earlier, is our lease term wizard. So our lease term wizard within LeaseCrunch is going to help us talk about early termination and renewal. So as you can see, I'm going to enter in a lease that starts on 1/1/22. This is a transition lease. Say we've accounted for it for a couple of months under 840, and then we're going to move that lease forward to 842. Next, I'm going to talk about our early termination. Early termination. So one of the things that I think Frank touched on earlier was that reasonably assured or reasonably certain. You can see here that one of the ways we can help you here in LeaseCrunch is reasonably certain is underlined. And if you click on that, it's going to take you to our help guidance specifically about that topic. So are you reasonably certain to bypass an early termination option? If you are, then we're going to ask you about renewal options. We need to take all of these things into consideration when we're transitioning our leases and when we're entering new leases. And when we do so, we're going to enter a new end date here. When I finish my wizard, we'll see that my start date, end date, term, and ROU asset life have been filled in for me. And then finally, I'll have the opportunity to add comments about this lease and include any custom fields. As I click next, we're going to move into lease payments and classification, which includes discount rate. So we spend a lot of time here at LeaseCrunch talking about discount rate, and we spent a good portion of the last hour talking about discount rate as well. Throughout LeaseCrunch, anytime you see a blue question mark, you'll see that our tooltips are going to open in a new tab. With regards to our discount rate, you're going to see that we have those risk-free rates available to you just as a link. And we also have included some calculators to help you determine that implicit rate. Like we mentioned, we don't always know all of the inputs we need to have in order to determine that implicit rate. But if you do, we've got some calculators available for you as well. So I'm going to enter my discount rate. We'll say it's 2.5%. And then I'm just going to enter some payment information. We're going to say that this lease particularly changes based on our renewal. So then we're going to just enter that information here in LeaseCrunch. The next section you'll see is about existing balances. This is going to help you transition those leases from 840 to 842. This is where we're going to include things like deferred rent, capital lease asset and liabilities. Those things are currently on your balance sheet. We're going to transition into LeaseCrunch, and everything is going to flow through your ROU asset as part of your initial journal entry. So a big time saver here that you can enter all of that data right here into LeaseCrunch and get the information that you need so that your entries are correct. The next wizard we're going to show is our classification wizard. Here within LeaseCrunch, we are going to help you classify those leases as operating or finance leases. We talked about the different, I think Joe mentioned the differences in the classification or the differences between 840 and 842. And our classification wizard will help walk you through those particular questions so that you're always getting it right. I'm going to call this a finance lease for the sake of our conversation here today. And when I roll this forward, we're going to see that LeaseCrunch has remembered our classification, and then it's only going to pull in GL accounts associated with this lease classification. Frank, Kevin, and Joe know that this is my favorite part of LeaseCrunch. As a former accountant, I don't have to remember my GL accounts, which is number one in my book. So we can also support your cost center allocations. If, for example, you have those for your organization, we'll support that as well. And then we talked about variable expenses. So the guys did a great lead-in for me here today to make this type right back into the presentation. Those variable type expenses, maybe you have non-lease payments associated with your non-lease components. This is where you'll enter that information. Maybe you have variable type expenses that are changing throughout your lease. You'll enter that information here as well, because that will then print out on your footnote for you. So I'm going to skip this particular section here today, but know that variable expenses are something that can be added right in LeaseCrunch. And then finally, we talked earlier about documents and attachments. So within our system, we're going to be able to add the lease files that we have already scanned in. Maybe we've got that electronically signed PDF. We can put that original lease file here in LeaseCrunch. That way, you'll have all of your lease information in one spot. When I click finish, we're going to be taken back over to our My Leases screen. This is where we begin when we first log into our system. I didn't show this screen earlier, but this is really home base. And what I want to do next is take just a few minutes to run a few reports. We'll talk a little bit about our journal entry, amortization schedule, and footnote. I'm selecting My Leases, and at the bottom of the My Leases screen is where we're going to see those reports. For the sake of our example here today, I'm going to run my journal entry for an entire year. I can also customize my journal entry columns. So if you are going to import your journal entries into your financial database and need these columns to be in a certain order, we can fully customize that. And when you export that journal entry, it's going to open up in the particular format we just created. Give that a second. So here's our journal entry. So we're going to see our first month entry here. One question we get pretty often is, how do I know, or what, does the system do that initial journal entry? And it sure does. We take the information that you're entering, we transition you from 840 to 842 as part of our initial journal entry. You're also going to see on this report that we have 3 tabs. Our tabs are going to always include the information that you have included on the report. The next tab is our leases. This is going to be all of the lease data for this particular report, so you'll always know what was included. Next up, let's take a look at our amortization schedule, which I'm going to pull one up that I've already got open for us today in the interest of making sure we've got enough time. So our amortization schedule is going to be the same leases we just included. It's going to be that horizontal view of those entries. And this is a great report because we use this to tie back to our general ledger and make sure that our information had been reported correctly. And then finally, that footnote, our footnote is going to show some of the disclosure items we've already talked about here today. We're going to see our annual lease expense information. We're going to see a group of other information, things like our ROU assets obtained in exchange for new lease liabilities, our weighted average remaining lease term, and our weighted average discount rate, separated by finance and operating leases, and then also that maturity analysis, also separated by finance and operating leases. And again, you're always going to have the criteria that you need in order to keep track of what leases were included on that particular report. Frank, anything else you'd like me to talk about?
No, I think that's it, Jess. And every time I see this, it just becomes more and more evident that software is the way to go. It just makes things so much easier to get through. Why don't you stop sharing? I'll share my screen, and we can head into the wrap-up portion. Hopefully, I can figure this out and get us back to the right screen. If someone can let me know if they're going to see the recap slides, that would be helpful. So, for December year-end companies, the implementation date has passed, and for municipalities and not-for-profits, it's coming here pretty closely. So we suggest that you act on this as soon as possible. And based on the answers to some of the questions that we've seen today, some of you are still not probably where you need to be at this point. We have transition and adoption guidance along with other tools that we believe will help companies be successful in adopting the standard. We're here to help. We've set up a landing page on our website, which is on the slide here. You can sign up for a 15-minute consultation with us by inputting your information, and we'll be doing some follow-up with you after this presentation as well. And so,
hey Frank, right now you have the presenters view up, so the slide's a little bit small.
Sorry. Let me stop sharing and just make that a little bit easier so that we can get through the rest of it. Sorry. And so some topics for the rest of what we're thinking about would be lease modifications. We're going to touch on financial statement presentation, and then kind of the post 842 adoption lessons learned and best practices. So if you've got anything else that you'd like us to cover, please chat that in. And with that, let's take a look at some of the questions that are in the Q&A. So the first one that's in there is, should hardware as a service arrangements be treated as a lease? Joe, I think the answer there is most likely, right? You're going to have to look at it and see if it meets the definition. But we talked about an example of that during the presentation. So I think that one's relatively an easy one to take. The second one there is about CAM charges that are updated yearly on a multi-year lease. Would those be considered variable payments and need to be treated as a period expense? And once again, guys, thoughts there?
So there's always, a little bit of detail for each situation, but if the CAM charges were maybe known and listed out in your lease agreement annually ahead of time, they would not be. But if they're changing and modified each year, then yes, they would be. So that's kind of where the nuance is.
Okay. Then we had a question here. Does the 1-year exclusion expedient apply to lessors as well? I think on the lessor side, it's not really all that challenging for 842. Would you agree with that?
Yeah. So on the lessor side, there are just not many changes compared to what we have for the lessee side. The lessor accounting is actually pretty consistent with how it was previously done. So I have not seen any guidance that specifically refers to an expedient on the lessor side of excluding that 1-year lease. But on the lessor side, you would still be reporting that lease as you would have under the old standard. So it wouldn't really change much there.
Okay, and then we got a question about cash flow presentation. I know we're going to cover that in a future webinar, but can you hit on that real quick, Joe?
Yeah, so for the cash flow presentation, the easiest way I can explain it is, think of how when we show depreciation expense as a non-cash change up in the top of that operating section of our cash flow section, that's where that right of use asset activity is going to go as well. So that's kind of the easiest way I frame it in a quick summarized version without getting into too much detail. With the question about the title on the cash flow statement, there can be some customization there, but it's probably just going to be something as simple as right of use asset operating lease, right of use asset financing lease, because those two are going to be shown separately.
Yeah, and then there's also on a financing lease, you're going to have something down in the financing section as well. So it really depends on the type of leases that you've got. But I see that as a relatively simple item, especially when you're thinking about prepping a cash flow worksheet. I was reviewing a set of audit work papers yesterday, and it was very easy to follow. So I'm confident that that's not going to be a big issue. Eva wants to know if we can get the IBR from a client's bank. I think that's going to be a little bit of a mixed bag. For private companies, I just don't see a lot of them using the IBR. It's hard to get, and I think if you're a company that's going through an audit, you're going to get challenged on that. And it seems to me to be more trouble than what it's worth, to be honest with you, when you've got this practical expedient on the risk-free rate. Kevin or Joe, would you think any different?
No, I agree, because the great thing about the risk-free rate is it's a known number. It's a very easy to audit number. It's simply based, if you have a 5-year lease, You use the 5-year risk-free rate as of the adoption period, and you're done. It's that simple. So that is a 2-minute exercise to determine that rate versus emails with your banker, phone calls with your banker, providing documents, reviewing variable inputs, things like that. And in the end, we don't anticipate that the balance sheet impact between going through the exercise of using the IBR and having that slight variance in what that right of use asset or lease liability ultimately is going to be is worth the time and the effort that it takes to come up with that.
Yeah, we're at time, but I want to launch that last polling question so we can make sure everybody gets CPE. So can we launch that? And guys, I don't need to be in a share mode, right? That'll come up. Okay, so how many leases does your company have, finance and or operating? So those of you that are still on, I'll wait until we get up close to 72 before we end this. And we can keep going. I know people may need to drop, but we've got a couple of more questions in the Q&A. We're happy to stay on and answer those for you. So we're about 54 people, 55. Maybe we can just keep going with that. I'll leave that up there for a second. With the new lease reporting requirements, have you discussed landlord or lessor reporting of this or lessee only responsibility? So as we said at the outset, we're not really going to spend much time on the lessor side. From what I've seen, it's not really incrementally that difficult to get to that information. It's really more of dealing with it kind of on a straight line basis, right, Joe, as it comes in?
Mm-hmm. Exactly.
Yeah, so we're at 58 people in terms of that last poll. I'm going to end that and share that. So the lion's share, it's about 25% in each bucket, really. So 1 to 5, 6 to 15, 15 plus, and then still trying to figure it out. And that's kind of what we've seen as we've done these implementations. It's a little bit all over the board. Let's see, there's a couple of more questions here. Does LeaseCrunch integrate with QuickBooks Online? LeaseCrunch does not do an integration, so it's going to push a journal entry out that you will have to record, but it is going to give everything to you in an Excel-like format. A few more lessor questions. For lessor, would typically the ROU asset initially capitalized be more than the liability recognized because of the discount rate applied to the liability? Joe, what do you think on that one?
So on the lessor side, there is some other nuance that we haven't really covered in many of these webinars here. There's things like sales type leases, direct financing leases, and I don't want to get too off the rails here. So I don't have a great answer for that on the lessor side, but John, if you want to shoot myself or Frank an email and I could take a little time to look into that for you and get you an answer, I'd be happy to do that for you.
Another question, is this reporting requirement for GAAP or all methods of accounting? And I think it's GAAP, right, Joe?
It's GAAP, but if anyone out there is under the IFRS standard, it's also applicable under IFRS. So those are the two main ones that are adopting this standard.
Yeah, I was thinking in my mind more like cash basis or
cash basis or income tax basis. Yeah, but that's not something that would apply.
Yeah. In terms of pricing, Eva, for that, set up a consultation with us and we'll cover that. It's really dependent upon your facts and circumstances in terms of the number of leases and the number or the amount of additional support that you're going to need. I think we've answered just about everything in here. Do you guys see anything else that we need to cover here?
So there's one more at the bottom. I'm not quite sure on this question. I'll read it out. We're a CPA firm that is evaluating the impact of the new lease standard on our GAAP FS clients. Not sure if that's a question or a statement, so I don't have an answer to that one.
Yeah, I saw that one. I wasn't quite sure. So if that was you that put that in, if you want to put a quick update to that, we can try and cover it. Otherwise, we'll have to answer that kind of post webinar here. Okay, so I think we're at the end of all that. I want to thank everybody for joining today. Keep a heads up for an announcement of our next webinar, which will be coming up in a couple of months. You can also visit the SSF YouTube page, which you can find on YouTube by searching for SSF. We have a ton of content out there relative to not only lease accounting, but some of the other offerings that we have as a firm. And that's actually been viewed quite well. So please feel free to take a look at that. If you have any questions, please feel free to reach out to us. And I know we will be reaching out to all of you kind of post webinar here. So thanks a lot for attending today, and we will see you in a couple of months.